what this model assumes is that those correlations stay static over a long horizon. And they do perhaps over a long horizon, but in reality, clients' lifetimes and their needs for funds are much shorter horizons. And over those shorter horizons, those correlations between these different assets that are the very foundation of this theory break down. They're not a static correlation. So the takeaway is there's not one efficient frontier. There's many of them, depending on what time frame you look at. So the whole model kind of breaks down in theory. Hello, everybody. It's John Lodra here. I'm a co-founder and partner here at New Harbor Financial Group, here for our weekly market video update. It is Thursday, September 5th, 2024. Summer's over, or at least the way we think about summer, and off to the races. September is typically, on average, a pretty interesting month in markets. And interesting, on average, means not a very good month. In fact, September is the weakest month of the year on average, and especially the second half of the month. I'm going to be the first to disclaim that averages can be useful in context, but they can also disguise a lot of, kind of nuance and deviations from average. So averages don't always hold. I want to talk about the question, are markets efficient? It's an age-old debate. I encourage you to like our video here, hit subscribe. It's the best way to make sure you get the content that we produce every week. Back to the question of, are markets efficient? And this was really prompted in my mind by an article that came out last week in the Financial Times. And here's the cover of that article. And it's basically a discussion with well-known economist Eugene Fama. Eugene Fama, he goes way back to the 60s and 70s. He's what one might consider to be one of the godfathers, if you will, of the efficient markets hypothesis. Pretty intriguing sounding name and title there, right? And in fact, it has governed and guided the financial industry and investment theory for decades. This headline, I think, is really important, because here you have one of the godfathers of this theory basically saying efficient markets is a hypothesis. It's not reality. Pretty stark admission, especially this many years or decades after this principle became the bedrock. So what is the notion of the efficient market hypothesis? There are a lot of definitions. I'm going to give you kind of my layperson's definition. The efficient market hypothesis, or efficient market theory, they go by both names, basically says this, that at any given time, the collective market is fully pricing in all the available information that's out there about the stock, any given stock, or the market in general. And therefore, the insinuation is that the market's always fairly priced, and there is no opportunity to outperform the market by making judgments of whether stocks or the market are overvalued, or security A is more attractive than security B in terms of mispricings and potential returns. The offshoots of this spin into things like the capital asset pricing model and modern portfolio theory. But the bottom line is, the thesis is that no opportunity to outperform and kind of add value by active management. And furthermore, the only way to increase your return is to simply take more risk. Again, it's been the bedrock of academia, finance classes in colleges the world over. And in fact, many investment processes of financial services firms are rooted and governed by exactly this. Perhaps the best real-world example of our markets efficient is, we can look to none other than Warren Buffett and Berkshire Hathaway. And Warren Buffett and his recently deceased right-hand man, Charlie Munger. Rest in peace, Charlie. And I thought this would be fun to look at some quotes that the two of them have shared over the years as relates to this topic. But first one, I'd be a bum on the street with a tin cup if the markets were always efficient. That's Warren Buffett. Let's continue with Warren. It's crucial to understand that stocks often trade at truly foolish prices, both high and low. Efficient markets exist only in textbooks. In truth, marketable stocks and bonds are baffling. Their behavior usually understandable only in retrospect. I like this one by Charlie Munger, now deceased longtime right-hand man. The possibility that stock value in aggregate can become irrationally high is contrary to the hard form of efficient market theory that many of you once learned as gospel from your mistaken professors of yore. Your mistaken professors were too much influenced by rational man models of human behavior from economics, and too little by the foolish man models from psychology and real world experience. That's awesome. Love that one. I love this one here. by Warren. Naturally, the disservice done students and gullible investment professionals who have swallowed efficient market hypothesis has been an extraordinary service to us. When he says us, he means people like him and Charlie Munger and Berkshire Hathaway that are value investors and try to invest in companies that are undervalued. He further says, in any sort of contest, financial, mental, or physical, it's an enormous advantage to have opponents who have been taught that it's useless to even try. What a great quote, because I'm a parent. I hope I've instilled in my sons that are now in their 20s that true success, whether it's emotional success, financial success, you name it, takes effort and trying. And I think there is no exception when it comes to investing in financial markets. Now, I'm going to also acknowledge that Warren Buffett himself has been on record as saying that he thinks for most everyday investors, especially those that don't have grounding in finance and how to think about valuation of companies, he says, well, for most investors, well, I think it actually makes sense for them to just passively invest in index funds because they're likely not to outperform the market. So it might seem like he's talking at both sides of his mouth, and he kind of is, but I think the reason he says that is that most investors truly are wired to do exactly the wrong thing. They want to pile into the stock market when it's making all-time highs and achieving valuations that are ridiculously high and untethered to reality. They want to jump out of the market at the bottom. So think about the tech bubble of 2000. Everybody wanted in at the top. Nobody wanted to own stocks at the bottom. Same with the great financial crisis. We were getting calls almost weekly in the fall of October 2007. People saying, hey, I've been in cash since the tech bubble. I see the market's going up and making new highs every day. I want to get in. And we were insistent that no, now's not the time. We are very overvalued. We have a major downside event likely in our future. And by March of 2009, the market had dropped over 63% peak to trough. And at that time, even after we had mitigated most of the downside in our clients' accounts, even our clients were skittish about us starting to get more invested in stocks at that time. So I think that's why Warren Buffett kind of has been on record as talking out of both sides of his mouth. Now, I'm not here to say that value through active management is easy. We work really hard at it, and it's not always easy, and you're not always going to outperform over the long term. I think history would be very demonstrative of this, is you sometimes have to underperform when things get crazy. And I think we're in one of those environments now. That's why we are fairly defensive still. We're only about 40% in equities for clients, and we do have some hedges there, even though markets are at all-time highs right now. We think that's not going to last. So I want to get back to some of the theory that underlies our profession. So I alluded to the fact that the efficient market hypothesis has a couple of close bedfellows, namely the capital asset pricing model theory and the efficient frontier. Again, this is academic theory that runs deep through the everyday advice that most financial firms will give clients. So here we have just a simple chart. On the x-axis is risk, expected risk. Going along to the right, more risk. Along to the left, less risk. On the vertical axis, we have the expected return. The higher you go up on the axis, the higher the expected return. Each one of these dots are meant to represent a hypothetical portfolio, mix of assets or individual assets. Now, the efficient frontier is this blue line here. And in theory, what it says is there are some combinations that are infeasible. You can't possibly have a portfolio that matches this kind of mix of risk and return. But there are all kinds of portfolios that lie in this realm of feasibility that are below this frontier. And what the efficient frontier model says is, for any given level of risk, you want to be on the frontier right here, for example, for this level of risk, because that's where you maximize your return for any given level of risk. So for example, this portfolio has a risk here, but you can find another feasible portfolio that maps out right here, where you get the same level of risk, but a higher return, and so on and so forth. This is a nice theory, but just like the efficient market theory, it's fraught with a whole bunch of problems. First of all, at the heart of these kinds of analysis is what they call cross-correlation between different asset classes, between stocks and bonds, different sectors of the stock market. What this model assumes is that those correlations stay static over a long horizon. And they do, perhaps, over a long horizon. But in reality, clients' lifetimes and their needs for funds are much shorter horizons. And over those shorter horizons, those correlations between these different assets that are the very foundation of this theory break down. They're not a static correlation. So it renders, so the takeaway is there's not one efficient frontier. There's many of them, depending on what time frame you look at. So the whole model kind of breaks down in theory. How this kind of plays out in the real world, for many financial firms that you might work with or choose to work with, the very first thing they'll have you do is answer a questionnaire. And that questionnaire will ask you for some boilerplate information, your name, social security, what your timeline is for needing funds, but also what your risk tolerance is. They'll ask you, what is your risk tolerance? And typically it's some qualitative metric like conservative, moderate, aggressive, all these kind of qualitative terms. Some questionnaires actually try to put a number on it, a risk score. With the higher the number, the more risk that an investor is willing to take. Now, again, the dogma of the academic theory is that if you take more risk, you're going to get more return. That's not always the case. I'll get to that in a minute. But that's what underlies this very central concept in most financial firms. We don't buy into this, frankly. That's why, for most of our clients, we're not really talking about a risk questionnaire because we think it's a very dynamic thing. In fact, we think most people don't even understand the concept of what is being asked of them. And let me share some thoughts on this. First of all, the idea of risk in these academic models is really what's called volatility. It's called the standard deviation of the price moves of a given security. Again, the theory thinks that securities are always fairly priced, but there's going to be some variability around that price history. I'm going to share a picture which I think gets to the core of the problem with this. This is a very simple graphical illustration of volatility. You have a security or a portfolio, and it's going to wig and wag up and down over time, but it may trend, right? So this is what we call as volatility. Now, a more volatile asset or portfolio will have wider swings around that basic trend line. That is not risk. Risk in the context of what we view it as and what we think most clients should view it as is the risk of permanent loss of capital or long-term loss of capital. And that the decline that happens there is materially affects the probability of achieving your goal. Now, volatility can go up and down like this, but it won't materially affect achieving your financial goals over the long term. But now a 30, 40, 50, 60, 70% decline in markets, that's what we consider risk. And that can absolutely devastate a financial plan and put at risk your goals. My point here is that the very question that is asked by our industry, by most clients and individuals, is a very elusive one because most people don't even understand the question. And the very models that are used to model this don't even think of risk in the same way that most people should. They think of the models, again, think of risk as this thing called volatility, not a permanent loss of capital. Because frankly, in the efficient market theory, that permanent loss, those big declines aren't supposed to happen because markets aren't supposed to get overvalued like that. They're always supposed to be rationally and efficiently valued. So in theory, these big bubble collapses shouldn't ever happen, but we know from experience that they do. I'm going to share a chart here that was put out by our admired John Hussman. So this goes back to 1928. Now, John Hussman and Jeremy Grantham and we will be the first to admit that valuations aren't really good short-term timing indicators, but they are very good long-term return indicators, or at least they have been historically. And that's the point of this chart. So what this blue line shows is based on the valuation metrics that John Hussman has done really cutting-edge research on. It shows the estimated loss in the S&P 500 to bring valuations back to norms that would be consistent with an expectation of 10% average annual future returns over a long horizon. In other words, when markets are tremendously overvalued, they need to pull back to be able to offer the prospective returns that seem embedded in people's minds and certainly embedded in things like the efficient market theory, 10% annual returns. The red lines here, red areas, I should say, are the actual in history, actual largest decline, deepest loss in the subsequent 10 years following the point in time. So for example, in 2000, this would have projected that the deepest pullback in the tech bubble would have been about 60%. In fact, that's what actually happened. Within the following 10 years, the market did pull back. Now, that happened at the very front end of that 10 years in 01, 02. here is the great financial crisis. In 2007, this blue line would have projected a 50% peak to trough decline at some point in the following 10 years in the market. And in fact, it was nearly a 60% if you include dividends pullback in the S&P. So here we are today. And so far, the market there's this big white area here. And so far, what has held true in history has not yet happened. And the point being of this chart is that this area in this yellow area is yet to be determined, meaning we haven't yet observed the full 10-year actual historical outcome yet. So if history is any guide, we will see a tremendous closing of this white area. And if you take at face value this chart, it suggests that markets would have to drop 70% from current levels to be consistent with a long-term return of 10%. Will that actually happen? We can't say for sure. It's certainly feasible and you might even say likely, if not credible. But what it simply means then is that the subsequent returns probably just won't ever, achieve that full 10% expectation. Maybe it only gets down to, maybe we drop 50% and it's only like 7% annual returns or something like that. But this in a chart, I think, is one of the most compelling, besides the evidence of folks like Warren Buffett, one of the most compelling evidences of the efficient market just doesn't exist in reality. Otherwise, these huge declines never, ever would have happened. It's just not allowed for in the theory. I'm going to try and bring it back to today's markets. And, here we are. We're at valuations, at least in the U.S. stock market, that are absurdly high across the broad market, on par with top of the tech bubble in 2000 and the peak of the market in 1928, back before the Great Depression. Now, there are certain sectors and geographies that are more compellingly valued, but broadly speaking, we're in a very overvalued market. So we do expect that the irrationality that we think is in these prices will come home to roost, and we'll get a pretty decent sizable pullback that will be probably shocking to many because it doesn't feel like that's possible for many, but it never does in bubbles. So we'll be watching for that, but trying to make forward progress, of course, but playing defense at the same time. Big news this coming in a couple of weeks. We have the Federal Reserve meeting on September 18th, I believe, where they're going to announce the rate decision. Now, the market is pricing in, I didn't look at the odds today, but yesterday it was pricing in a 57% chance that the Fed was going to drop rates by a 1/4 percentage point, and a 43% that they would drop by a full 0.5%. Of note, a month ago, the market was pricing in over 80% likelihood of a 0.5% drop. So those odds have shifted a bit. Back to the question of are markets efficient? I've been making the comments and observations and comments on other videos and to our clients that, here we have, if you look at the rate market expectations of rate cuts coming over the next several months and over the next year, the markets has priced in a full percentage drop in interest rates by the end of this year by the Fed. So from 5.25 to 5.5 range to 4.25, 4.5 range, a full percentage point drop by the end of the year. And by next July, a full 2 percentage point drop. So call it 5.25 down to 3.25. My thesis and my comments have been that's a pretty aggressive rate drop. Certainly, we think that the only scenario where something like that happens is if we have material economic weakness and stock market weakness that follows through from that. In other words, the Fed is having to panic cut to try to stem the slowing of an economy. And I'm going to share a chart and observation by Bob Elliott that I think speaks to exactly this. What this shows is it shows we can look at actual 2-year Treasury notes, and those yields are now below 4% on 2-year Treasury notes. And if you take the difference between the 2-year Treasury yield and the federal funds rate, which is, basically the federal funds rate traditionally tracks very closely the 2-year bond. And the difference is, you might say, how far ahead the market is pricing in cuts before the Fed actually has made them. And the only time in history where you see this level that we have right now, it's not where stocks were at all-time highs. Essentially, the lows of the great financial crisis, the lows of the tech bubble. This, I think, is the 1987 crash. So there is basically a very irrational inconsistency between the stock market and the bond market right now. The bond market is pricing in these pretty aggressive rate cuts, but the stock market is making the assumption that, hey, we're going to get those rate cuts and it's going to be Goldilocks and the economy is going to stay solid and no landing, soft landing. And history would suggest that's absolutely absurd. That only the only likelihood of getting the rate cuts that we're going to see there are with a pretty dramatic slowdown in the economy, and we think accompanied a pretty strong stock market decline. And on the other hand, if we don't see that slowing economy and stock market decline, there's a very good case that the market has gotten too aggressive in assuming the Fed will cut as quickly and as deeply as they will, which we think could likely invite its own sense of disappointment, because there's all kinds of assets that have rallied on this assumption that rates are declining and it's going to make things all peaches and cream again. So very, very tricky time. I think the Fed meeting in September is likely going to be more important as to what they say in terms of future trajectory than the actual whether they cut a 0.25% or 0.5%. That's pretty much all I wanted to cover today. I want to thank you for watching. We invite your feedback. We invite suggestions on topics that you want to hear about that we can hopefully educate and provide some insight on. Thanks for watching, and until next time, I wish you have a great day. Bye now.